So hi everyone, thank you very much for coming out tonight and braving the cold. And so when I set myself this task of 80 trades around the world, I wasn't realistically going to take you through 80 trades tonight, but we could if you really wanted to. So what I've got is about 5 or 6 trade ideas, which we'll hit at the end. I just want to take you through a little bit of a thought process about how we think about offshore investing as a South African sitting in rands. And understanding that I am in the JSE, so I'm going to talk about JSE listed instruments, and I am kindly being invited by Discover Derivatives, so we're going to keep this to derivative products. So I'm going to have a couple of slides just introducing how derivatives work, etc. So for those of you who know how derivatives work, you can switch off for that period of time, or maybe use it as a refresher. We're also taping this, so you can go and watch it again as a webcast later on. Thanks to JSE, it will be available on the website. So a couple of things I want to just go through. Why offshore? My theme called investment staycation, and I'll explain that a little bit more just now. And then a couple of ideas or themes that we have at the moment. And some of these are borrowed. They're not all my ideas. They're borrowed from my guys, from Robbie, our technical, who does a lot of our technicals, from Gary, who a lot of you will know from CNBC. He's got one trade idea in there, and then there's a couple of my own ideas that I've thrown in. So why offshore? So in our opinion, offshore is compelling and remains compelling. If you aren't going offshore, you're mad. So why? One of the reasons is, and no disrespect to the JSE, this market is tiny. Africa as a whole is exceptionally small. And this is a slide that I used when I was invited to speak at Trade Tech in Paris. All of the JSE and all the African markets together, the whole market cap only make up 9% of the New York Stock Exchange. So that's the whole of Africa. That is whatever number of exchanges there are. And the top big 5 plus the JSE makes up 8% of that relative to the New York Stock Exchange. So in terms of market cap, we're a fairly small market, being the JSE and the other exchanges. In terms of liquidity, it's even worse, because in terms of market value traded, the JSE is 2% of the size of the New York Stock Exchange. And the rest of the African markets are only 0.2%. So in fact, the JSE is 10 times bigger than all the other 5 biggest exchanges put together in Africa. And the New York Stock Exchange is what is that, 50 times bigger than us. So if that's not a compelling reason to feel like you're a big fish in a small pond here, you need to go and become a small fish in a much bigger pond out there. And there are 28,000 tradable instruments on one of our platforms that you can trade. So I'll keep this presentation just to the couple of thousand that are available here, but you need to look offshore. South African JSE dominates this market. It's 90% of the market cap and the market liquidity of the African markets. The other reason, and I'm not a fearmonger, I'm not one of these guys who says you have to, I'm not one of the guys who jumps ship. But this is a quote from Investec that came out in a morning note a couple of weeks ago. And I think we have to take cognizance of this. We are in an environment where the fundamentals are not great at the moment. So whether that's Eskom strikes, whether that's the rand depreciating, whether it's a deficit, whether it's credit re-ratings, we unfortunately are swimming upstream to a large degree in our economy and our markets at the moment. And against that, you've got to believe that the rand will continue to weaken. And as a South African who sits in rands, you need to be taking money offshore and putting them in stronger currencies. So this is not my quote, but we do buy into this philosophy that you should take your maximum amount that you could take offshore. You must go into a firm currency. However, it's not all gloom and doom in our markets. So this is from our strategist, Johan Rousseau. This is he always does a 12-month, and we make this available to our clients. He always does a 12 and 24-month rolling forecast of where he thinks the high road, low road, and middle case would be. So if you take the mid-road base case, he's still looking at about 12, 13% growth between now and 12 months out on our JSE, well, on the all-share, 12 months out from now, including dividends. So that's not too bad. I mean, that's still beating inflation. It's still beating cash. His bear case is about a 5% pullback in the market between, not saying there couldn't be more in between, but he's saying worst case scenario, 12 months out from now, the market could be down 5%. Best case scenarios, we could be about 28, 29%. That's his sort of range. Like an economist, he's always on one hand, you could get 28%, on the other hand, -5. But if you take 12, 13%, it's still not a bad return. Also, having a look at different asset classes within that, our preferred as a house still remains financials at 12.4%, then resources, broad-based equities 10% plus your dividends, which is about 2-3%, that gives you that 13%, then property, bonds, and cash in order of our preference. For local industrials, only 7.8%. So our theme in our portfolios at the moment is still tend to be overweight financials. We've started bringing up our resources components in our portfolios, and we've started underweighting our industrials. That being said, the best place to be at the moment, if you believe our economist, our strategist, is offshore, because the MSCI World Basket, which is a basket of all the world exchanges, is looking about 13.3% in rand terms. So you can clearly see why we think that you should be taking money offshore, because you can earn 13.3% as opposed to 10% on our local bourses. So this is, once again, just to give you an idea where we think in terms of asset allocation. If we were to spend money at the moment, where would we be putting it? So we're kind of very neutral on equities locally. We just think equal weight. So we're not overweight, not underweight equities. Bonds, we're equi-weight. Interest rate cycles coming is coming through. Interest rates are going to go up. So we're equi-weight bonds. Cash, we're holding a little bit extra cash in portfolios at the moment. And listed property, we're bang on equi-weight. So that's not very exciting. So we're equal, equal, equal. Where we are overweight, though, is we are overweight offshore equities. So we are at almost close to our maximum that we can do in terms of our prudential allocation. So that allows us to take 25% offshore in terms of our prudential allocation. In terms of Reg 28, we will be close to 25% at the moment. So we are overweight offshore equities. We're underweight offshore bonds. We just don't think that you get paid anything in terms of offshore bonds at the moment. We'd rather go into other asset classes. So overweight equities, underweight bonds, and equi-weight offshore cash. Offshore cash doesn't pay you anything, but clearly you do need some cash component offshore. So in terms of selective weighting, as I say, we're about 3% overweight in terms of international equities. This is sort of big picture stuff. This is just kind of themes. So I'll get to the nitty-gritty just now. If you had to look at our standard model house portfolio at the moment, and it hasn't changed month on month, domestic equities, 45%. Offshore equities, 23%. So we're sitting at about 68% equities. We've been heavier than that. We got up to 75%, which we're allowed to do in terms of our prudential limits. Commodities, you know, for me, commodities and asset class is something that you should always have in a portfolio. 2.5%, which is our model portfolio, is a bit light for me. I would, in fact, have more than that. I would have 5 to 10% in commodities in the portfolio. Listed property, we're underweight on listed property relative to, we've been as high as 13% in listed property. We've pulled that back right down to 5%. Domestic bonds, 15%. We've been as high as 18% there. So we're kind of there or thereabouts equal weight where we've been, and a little bit of cash. So that would typically be our weighting. In terms of our strategist, the little block there shows what his opinion is of whether you should be adding to that portfolio. So you can see offshore equities 23%, and he's probably going to maintain that weighting. So does that make sense? That's typically, if you were looking at your portfolio, that's how you would weight each of the asset classes. So now this is a real portfolio for one of the portfolios, and the title portfolio, formerly known as Titans, is a bit of a play on the fact that, I don't know if you remember an artist a couple of years ago called Prince, who then changed his name to Symbol, and then changed his name to artist formerly known as Prince. So when our portfolio manager came up with this portfolio, he called it the Titans portfolio, and I hated it. I didn't like the name. So it's now become portfolio formerly known as Titans, yet to be renamed something else. But I couldn't fit that in there. So currently portfolio known as Titans. What we've employed here, and this is a strategy that you might want to look at as an investor. It's a very simple strategy. You buy yourself a whole lot of beta. You buy the market, general indices, and then you add some sexy stuff around it. So if you have a look at what we've done in our offshore portfolio, we're sitting with a passive component. So that's this section here. So we're tracking Asia, China, FTSE, Euro stocks, Japan, and those are the weightings. You see we're sitting there with about 60% beta. So that will just track the market, those markets. And then what you do is you add a little bit buckets of alpha. You can call it alpha. Some people call it active components. Some people call it satellites. You add these little equity components around it. And you can see some of the stocks that we've chosen to put around there are quite well-known names. So, you know, Cisco. Samsung I've put in there, I've highlighted because I want to chat about Samsung a little bit later. It is in one of our trading strategies. So if you are creating an offshore portfolio and you are not really a stock picker, but you kind of know which areas you want to be in. So you want to be in the BRICS, or you want to be in the civets, or you want to be in whatever, however you come up with your weightings, it's good to start off with a big chunk of beta because at least you're getting the market. So you can see we have got 28% at the moment, 28.5%, and this is real. This is a real portfolio that we have for clients. We have 28.5% that sits in the US at the moment. So we've got a big chunk of US. And then around that we've added 10% in Europe, a little bit of FTSE, so 5%, and then some Asia, Japan, and China, etc. And that forms our bucket of beta. Then around that we've added what we think are decent, reasonably good growth stocks with dividends, you know, healthy stocks. We haven't gone for a real punting portfolio here. So if you want, you can go and replicate that. That's easy enough to go and replicate that. So the first thing that you need to do when you employ a strategy to go offshore is to choose what instrument. Unfortunately, the JSE has quite a few instruments for you to choose from that you can trade in your normal account. So this is my theme. This is what I call my staycation. And the term staycation came around about 8 or 10 years ago when everything went pear-shaped and we had all the financial distress. And suddenly people in America didn't have money to go on holiday. So they said, I'll stay at home, and they called it a staycation. So I take a long weekend or I take 2 weeks off, but I stay at home or I stay close to home. And that became the term staycation. And this trading philosophy that I'm going to put up for you now is based on staycation. You stay in rands, but you invest offshore. You go and pick some really good instruments that are available on the JSE offshore, but you trade them in rands, and you trade them in your normal equity derivative account, your normal SAFEX account. So effectively you're getting the offshore economic exposure to these wonderful stocks, but you're still in your home currency. Now, the obvious thing is, but that doesn't hedge me against any of the rand impact. So what you could do is you could bolt on a currency futures, rand dollar futures position, and that would immunize your portfolio against the dollar rand. But that isn't the brief. I'm not going to talk about currency futures tonight. I really want to concentrate more on the tradable instruments in terms of getting you the equity offshore exposure. So first of all, for those that don't know, a derivative, effectively a derivative is defined as a purchase of empty air. You don't actually own something. You have a reference underlying that moves around, and you derive your value from what happens in that underlying. That underlying can be a share, can be an index, can be a currency, it can be a commodity. So you'll see on the JSE we have derivatives. It can be a fixed interest, it can be bonds. You'll see on the JSE we have all of those. So as a client of ours, you can trade a derivative on any of those. Typically a derivative is geared. I mean, that's its nature. You put down a small amount of money and then you get a level of gearing, and that accelerates your profit or makes you massive losses depending whether the market's going for or against you. And remember, derivative, never blame the derivative when it loses you money. It's just the instrument. It's what you do with it, you know, that's dangerous, not the instrument itself. The other thing about a derivative and we're not going to talk about it tonight, that is very useful is the ability to go short. So if you think something's very, very expensive and you think it could go down, you can go short using these derivatives as well. But all of the strategies that I'm going to show you tonight are long strategies. That means we're buying it and we're expecting the market to go up. So the typical instrument choices that most retail clients would trade with us in terms of equity derivatives, single stock futures. Single stock futures have been around 15, 16 years now, so they're not a new instrument. Exchange traded CFDs, which have been around about a year. Is that right? About a year, just over a year. Still finding their feet, but a very, very useful instrument for clients to trade. And international derivatives, which have been around about 7 or 8 years, and there's quite a lot of them on our exchange, which are local instruments, but that are linked to offshore shares or indices. So the main difference between those three is that single stock futures and international derivatives are both futures contracts. And I'm not going to go into what that means, but they are handled differently to how a CFD is handled. A CFD is a contract for difference. It's not a futures contract. And effectively, you own the underlying, and then the dividend is paid to you, and then you charge interest for the position. Where a futures contract, you actually work out a futures price, which is a present value calculation. It's quite technical. We can unpack that, over a drink or so later on if you want. So, why should these things interest you? Well, single stock futures. So apart from the fact that there are single stock futures on pretty much anything that moves in our market, there's probably, 160, 180 single stock futures on individual shares on our market. What there also is single stock futures that are on some very nice broad-based ETFs. So, for example, the Deutsche Bank European Fund, the Japanese, the UK, the US, and the World Index. So what that allows you to do is in your normal SAFEX account is to trade a single stock future that gives you exposure to any of those 5 baskets. And we can list more. These are just what we've clients have asked us or asked the market to list thus far. On the exchange traded CFDs, you can also trade offshore ETFs. So for example, the Deutsche Bank Japan, US, and the world. And the reason why those 2 are highlighted in green is I'm going to go through those 2 trades in a moment. And then in terms of the international derivatives, there is just a plethora of these things that you can trade. So currently, the last time I looked, there was 268 of them. I think there's slightly more than that now. So 268 offshore instruments that you can trade locally in your local account. So that's 16 indices or ETFs and about 252 offshore shares. And I've put in there the little code. So it's the US, it's Spain, it's France, Britain, China, Australia, Canada, Germany, et al. There's a lot of markets that are covered that are shares are included on the IDX market. Was that a hand? Okay, go for it. They're not on screen, they're report-only trade. We can chat about that just now. So they're indirectly on screen because you trade the underlying equity and then it's report-only traded. Which makes them quite efficient because you're trading in where the liquidity is. You're trading in the underlying spot equity market. But we can unpack it a bit later. So the other thing about these IDXs is that you'll know all these brands. So it's the Facebooks, it's the Berkshire Hathaway. If you can afford to trade Berkshire Hathaway, I definitely want you as a client because I think the margin on that is 100,000 Rand. It's something ridiculous so that you can track Mr. Buffett. So why don't you come and buy half a dozen of them through me at 100,000 Rand a pop? I'd be very, very happy. But all of SmithKline Beecham, these sort of decent stocks that lots of banking stocks, lots of mining stocks are listed there. So that's the sort of universe, the trading instruments that we can trade. So let's go through a couple of our trading ideas to give you a practical feel for how these things work. This one's here just to show you this is a pure punt. Okay, so there's 2 here we can trade if you want to play China. You can either trade the FXIG, which is based on the China 25, or you can trade the MSCG. Both of these are IDX futures. Both of these are geared. The reason why I haven't bothered to even give you a trade idea here is have a look at it. This is a punter's paradise. So this is the same as trading the ALSI. If you know the ALSI index, which is our most liquid futures contract on our market, which moves around quite a lot, and you can trade it intraday. That's all I would do with this one as well. This is a punter's. I would buy this on dips. I would trade it, and I wouldn't even bother to try come up with a long-term trading strategy in something that looks this much of a mess. So that isn't a trade idea. That's a punter's paradise, and if you want to chat with us about trading that on an intraday or short-term basis, very happy to help you out with that. So that one is purely for the punters. So if you're not scared and you're very brave, come and join us playing on that one. This is Gary's idea, and I don't know if Gary is here, he's outside. So Gary punted this one out to our clients, and almost nobody followed him on this trading idea. And this was, he put this idea out, and what we do is we typically put a trade out where we say, we make it very simple for you. There's a big buy button, so you know it's a buy. We kind of put in the instrument information, and we tell you what level we think you should buy it at, what level you should stop out at, and what level you should take profit. Now there's some thought process behind that. So what we're trying to do in most of our trades is you want to try and make 2 rand on the take profit for every, and I don't know if my maths is going to work here because one of my colleagues is smiling, so maybe the maths doesn't work here. But you're trying to make 2 rand for every 1 rand you're willing to risk. That's always in our thought process in terms of money management. Because then if you only write 50% of the time and your 2-to-1 works, you'll still make money in the long run. This one's he was looking for quite big moves, so he was looking for a gain here of 90%, and I'll explain that in a moment. And he was willing to risk 51%. So that's quite dramatic moves. So you can see what happened with Starbucks. Starbucks actually came down, and technically it was starting to re-rate, and this was just before earnings came out on Starbucks. So the trade idea that Gary promoted out was Starbucks, good company, earnings are going to look good. They're looking at international distribution. Have a look at the trade, buy it at around 71. So I wouldn't even bother to go out and do this trade now because unfortunately that is now trading at 78 up there and pretty much at target. But I think if the Starbucks, and the reason why I still used the slide was to prove that we're very clever and we come up with winners, and it's very easy to do that in hindsight. But I do think this is a trade that if it did pull back, you probably want to still look at it again. If it pulled back to the sort of 70, 72 sort of area, I mean, give Gary a call. He can talk you through this trade. But I do think that this is a trade that you might want to have a look at on a bit of a pullback. But the point about the trade is that you as a South African sitting in rands, using an IDX future, could have bought Starbucks. Its trading code is SBUX in the States. So if you go into NASDAQ.com and type that in, you'll get a whole lot of research about the stock. Its local trading code on IDX is SBUG. So when you trade, that is actually what you will own. The margining was around about 10%. So when you trade that stock, instead of paying 71 Rand 13, you'll actually pay 7. You'll put down a margin of 7.11. Sorry, this is in dollars. Clearly, it would be in rands when we quote it to you. So gearing of about 10 times. So when I say 90% return, that's because the stock will move 9% in the underlying and you're 10 times geared. Clearly, if it falls 9%, you're going to lose 90%. So remember, gearing can make you money, can lose you a hell of a lot of money. This is an IDX future that we asked to have listed on the JSE. So this is the global social media ETF, and this is a basket of the top 29 social media companies. Now, social media companies don't make sense to me at all because they don't make any money. They make no profit. Well, they make some revenue, but they make no profit. But they're just massive. They're massive, and they will somewhere in the future be able to monetize that hopefully into profit. But if you look at this, index on the social media index, it's just been one-way traffic. And you'll see there's the listing of, it's not very clear, that's Twitter, that's Facebook's listing. So this is an ETF, it's a US-based ETF, and it basically includes the top 29 social media platforms. So Facebook, Twitter, Groupon, Alibaba, the Pandora, and quite interesting about this one is it's not just a US-based product. So the underlying, as I've put up there, 29% of the social networking stocks are Chinese, and another 18% are Russian-based. So effectively, you're getting a bit of global distribution as well, except that the internet is international anyway. So really, that geographical doesn't really make any sense. It won the Bloomberg Award for the best rising or most promising ETF in 2013. So what's interesting about this is if you buy into the whole social media hype and nonsense, this is a wonderful thing to put into your, well, I mean, everybody has Twitter and Facebook and LinkedIn and even me nowadays. So this thing went and did a high of $22. And my whole story about this, when I did this initially, I looked at this thing, was I was saying at around about just below 20, it's a damn good idea to get into this. And then fortunately, I took it off my watch list. And then recently, when I updated this watch list, I found out this thing did a low of 16.5. So if you just take a normal Fibbo retracement, it's somewhere about 50% retracement. And Jaco is actually one of my colleagues there, is an expert on Fibos, Fibonacci retracements. It's not a bad place to maybe look at buying this thing at 16 Rand 36, $16.36, sorry. So this is listed on IDX. You can trade it. Once again, it's picking up a phone, phoning someone like Darren and saying, please go and get this for me. He will get a market maker to actually go and buy it in the States, and then they write you a local contract. Once again, if you wanted to do technicals on this, you would have to do technicals on the offshore instrument, which is, its code there is SOCL. Okay, this one's a little bit easier for you to plot. So this is the DBX US tracker. And I asked our technical analyst to, and just to give you a feel for what goes into a DBX US tracker. So this is all the sectors. So you can see it's fairly broad-based, industrials, financials. So it's as you would expect. It's the S&P 500. It's quite broad-based. These are the sort of stocks, the biggest stocks in it, Apple, Microsoft, you know, as you'd expect, these are big blue chip counters. This is what it's done. I mean, clearly the US over the last year or two has been a phenomenal run. So I asked our technical analyst to do some work on this and tell me levels where this becomes interesting. And he likes this level here, this pullback and this potential breakout. So the way to trade this is the underlying instruments, and it's on our exchange. So this one you can go and put into your technicals. You can go and it'll be in your downloads. So it's the DBX tracker. And I can't remember what DBX MSCI US will be. DBUS, I think, Darren? In DBX US. Look for that in your normal technicals. It'll be rand-based, and you'll be able to do technicals on it. And the ID and the futures contract, this is a future. So we're doing a single stock future here because it's got a Q behind it, is DUSQ. And its gearing at the moment is about 11 times gearing. And you have to put down margin of 181 bucks, 181 cents to buy that position at the moment. So here's what, and let's, by all means, watch this trade over the next couple of weeks, see if we got this right or wrong. And you know, technicals are not the be-all and end-all, but I think that Robbie might have this one right. You know, it's pulling back. He wants it to push up there. That's a 15% move. If he's right on this one, it's 15% move on 11 times gearing. It's 165%. You know, I would assume he's got a stop loss level somewhere down here at the previous low, and he will get out of the trade somewhere there. So that's a real trade idea. You can go and try that out, paper trade that one. It's certainly an idea we will send out to our clients. We're probably not going to look for 165% returns. That's just ridiculous. We'll probably cut that way before then. You know, typically on our trades, if we get 30, 40, 50% on that trade, we'll put a trailing stop in there, and we'll bank that if we're that much in the money. So that's the first sort of one of the ideas that I think you should have a look at. Another one, and this comes from Gary. Gary loves NEPI. Why you'd want to buy a property stock that only has Romania and East Europe, your property is going to probably get annexed by the Russians, but Gary loves this thing, and the market loves this thing. And I asked our technical analyst to see if Gary had the right idea on this, and in fact he said, charts is pretty boring, but investors like boring. The trend is strong. So you know the old saying, the force is strong in this one. That seems to be the case. East European properties with a huge Romanian. So have a look at NEPI. It's run very hard. Let's be honest. But a pullback, and interestingly, it was about the 88. When I first looked at this, I thought 88 Rand looked appealing. It was confirmed by our technical analyst. So what he's saying there is on a pullback, because currently it's trading a bit higher than that. So on a pullback to 88 bucks, close to 88 bucks, look to go long. There's about a 6% upside here, and this is 8 times gearing, so that's about 50% potentially in that little move there. But you have to use this inclined support line as your sort of, you break that, it's kind of breaking out of that bull trend. And I must say, caveat emptor, I'm not a technical analyst, I'm a gut feel trader, but when I see something like that, it kind of makes sense to me that there's momentum in that thing, and I probably don't want to go short of it yet. So just to have a look at that in a different, this is the trading channel that that stock is in at the moment, and pretty much it's been bouncing around inside that channel. So as I said, we want to be accumulating at around about 80 bucks, and we want to be out of it. So that's a property stock. We don't like, you saw right at the beginning, we don't particularly like local property stocks because of the interest rate cycle, but we don't mind offshore property stocks in certain areas. And clearly Gary likes, maybe he wants to go there on holiday to Romania. I believe the countryside's wonderful, but this is a stock that he does actually like. Not sure if it's in our, Darren, can you remember? It's in our equity portfolios. It might be in our property component in our equities. Yeah. Okay, so that's NEPI. Oh, so that was very quick. So I'm just going to go back and just summarize a couple of the trade ideas then. China for punters. Whether you trade China, whether you trade Aussie here, always help clients with punting on these sort of things. Starbucks, if it pulls back to that sort of 70, 72 level, let's have a look at it. This one's my punt. I think social networking. And remember, right at the beginning, I had Samsung highlighted. So if you don't like the social networking companies, and there's a lot not to like, you know, you'd like to see things with a profit. That's a, you know, when a PE ratio doesn't make sense because you don't have the profit in the earnings component there, you know, that scares me. But if you don't like social networking companies, then have a look at the other things that make social networking work. So cloud infrastructure, the guys who actually make and do the cloud. So outside, somewhere in this building, there's a massive server warehouse in this JSE. You know, that's not a bad business to be in. So those sort of stocks, so the IBMs of the world, the Oracles, these sort of things, the guys that make this market work, the social networking. The other guys that you should look at are the guys that ship the technology that you see these things on. So when you go onto Facebook, Twitter, et al., you clearly use a mobile phone, you use a tablet. So you can't, Apples of the world, the Samsung is one of our stocks that we would always look at for a play in this technology space. So you need to look at those sort of handset devices, those tablets that make social networking. So if you don't buy into social networking, look at the hardware behind it, or the mobile telephony and tablets that make this world work. DBS, US, you know, this thing's got to crack sometime, but not yet. So we thought maybe the writing was on the wall. I think everybody did with this, you know, geopolitical concerns and first in Ukraine, now in Iraq, but it doesn't want to break. And while that trend is still in place, and I think this thing here almost got a few people to get short, you know, looking to hedge, you know, turn back up again. I would stick with that trend at the moment in the US. Record highs, I think, here we come. So, I mean, that was that move in the US that we're expecting. And then, as I said, NEPI, offshore property company. So effectively, a couple of different asset classes there for you, and we've looked at a couple of different regions. So we looked at US, you looked at social networking, which is all over the world, and then a kind of European property stock. Okay, I'm really up for questions.